Okay, I think we're going to get started. Good to see you. I'm glad you made it. Okay, we've got everyone here. Welcome everyone to this afternoon's jointly sponsored FIASI and the Fordham University Gabelli School of Business Climate Week, New York City 2023 Innovations in Sustainable Finance Fixed Income event. My name is Henry Schilling. I can't advance the slide, but
Try the mouse.
there we go. My name is Henry Schilling. I'm a FIASI board member and principal organizer of this event. It's good to see faces here that I recognize, including FIASI members, but it's also a pleasure to welcome many new faces. And I hope that some or all of you will in the future join us for other FIASI events. Thank you very much for joining us today. For those of you who are not familiar with FIASI, FIASI is a not-for-profit professional society. Our role is to educate members of the fixed income community, those that are involved in research analysis, portfolio management, and we also provide opportunities for interaction amongst members. FIASI is also the sponsor of the Fixed Income Hall of Fame, not to be confused with the Fordham University Veterans Hall of Fame. The Hall of Fame acknowledges and recognizes individuals within the fixed income community that have made significant contribution to the space. So individuals like Michael Bloomberg, Larry Fink, Harry Markowitz, some of the 58 individuals who have been inducted into the Hall of Fame since 1995 when we first launched this. I'm glad to report actually that there are at least two FIASI Hall of Famers here with us today. One of them is Andy Kalate. Andy, there you are, who was inducted in 1997. And the other one is a member of our panel today, Bob Litterman, who was inducted in 2020. Our next Hall of Fame event, by the way, is scheduled to take place next week on 9/26 at the Union Club. And if you'd like any information about the event, please see me or Lauren Nauser or Mark Howard if he's here, a member of our board. Now, before I go into the program, I just want to acknowledge a few of the individuals who have made it possible to bring this event to you. So at Fordham, these include Lerzan Aksoy, the Dean of Gabelli School of Business, Barbara Porco, who is the Associate Dean of Graduate Studies. And if it wasn't for Barbara, we wouldn't have the benefit of this wonderful McNally Amphitheater. So thank you, Barbara. And of course, a debt of gratitude to Professor Anyan and Professor Srish Chatterjee, with whom we have had an ongoing relationship, and they've been very supportive of this as well as past events. There are also a number of individuals on the Fordham side that have helped us pull this event together today, including Linda and Maimoon. Thank you very much for your assistance. On the FIASI side, I want to acknowledge Lauren Nauser's role. Lauren is our executive director. She does everything, including, I think, put an end to the rain, which might have precluded some of you from joining us. So thank you, Lauren. And I also want to acknowledge Bruno Mamant and Stanislas Royer for helping us put this program together. And of course, without our cadre of speakers, this event would not be possible. So identifying them in the order of their speaking arrangement, Tom Lee with APG Asset Management USA, Head of Credit Research, Fiona Stewart with the World Bank. She's the lead financial sector specialist, finance, competitiveness, and innovation. Bob Litterman, chairman of the Risk Committee and founding partner of Capos Capital New York. But Bob was also the lead on the CFTC subcommittee that published in 2022 a report entitled Managing Climate Risk in the U.S. Financial System. And Joseph Fichera, CEO of Sabre Partners. And finally, Peter Gaudet, Financial and Capital Markets Executive Director for S&P Global. Thank you all for joining us. The bios of these individuals can be found on our website. We're not going to go into the details during today's presentation because we're just pressed for time. Now, moving on to the program. The title of the program, as you saw, is Innovations in Sustainable Finance. And the thesis behind the program is that you may be familiar with green, social, and sustainable bonds. These were innovative offerings in their day. The first green bond was issued by the European Investment Bank in 2007. It was followed very quickly thereafter by a transaction that was launched by the World Bank. And the innovative elements of these bonds were their dedicated use of proceeds, reporting and disclosure framework that offered transparency regarding project evaluation and selection, management of proceeds and allocation of proceeds, and a recommendation to offer a second-party opinion. But otherwise, these bonds were no different than their conventional counterparts in terms of their credit worthiness. And in fact, if the same company issued two similar bonds, one was a green bond, one was not, they would have received and do receive the same credit rating. Now, fast forward 15 years. By some estimates this year, global issuance of green, social, and sustainability bonds will run about $1 trillion, more or less. And at $1 trillion, that still only makes up 4% of global long-term bond issuance, according to SIFMA. And that level is hardly enough to address the environmental and social issues that we face as a society. So additional issuance of these types of bonds is needed for sure, but also additional innovative financing solutions will play a role in addressing the world's environmental and social development needs. So today's program will focus on a number of innovative financing developments and solutions. But to be fair, none of the innovations in sustainable finance will gain traction if they do not satisfy the basic principles sought by most fixed income investors. That's a view that I have. It's a view that we expressed when I was still at Moody's in 2015, along with the head of Moody's Investors. And those characteristics are safety of principle, adequacy of risk and return profiles, and a quality of reporting that allows informed decision-making. So for this reason, I'm especially pleased that we're kicking off the session with Thomas Lee, working with a firm that manages some 600 billion in Dutch pension fund assets and working for one of the world's leading responsible investors. Tom is charged with the unenviable task of making decisions that balance fundamental considerations along with sustainable considerations. Tom will kick off the discussion. If we have time, we'll move on to Q&A, but because we're pressed for time and certain of our panelists have commitments that will require that they leave no later than 5:15, if we don't have time for to direct questions to Tom, we'll leave those to the very end. But following Tom's remarks, with or without Q&A, there will be a structured format style panel with each of the speakers taking between 12 and 15 minutes to focus on a particular transaction structure, framework, or investor class that qualifies as an innovative approach to addressing the climate and social challenges that we face. And at the end, we'll definitely have some, well, we will hopefully have some time for Q&A. And that will be followed by light refreshments and an opportunity to interact. So with that, again, I thank you for attending and participating in today's event, and I'll bring Tom to the podium. Thank you.
Thank you, Henry, for the introduction. Good afternoon, everyone. It's a pleasure to speak at today's event and get to share a little bit about the APG's experience in innovations in finance and sustainable investing. So just a little quick fact about myself. This is actually my first keynote address, so it could be my last, depending on how it goes, but just want to share that with you. A little background about APG, in case you don't know too much about us, but we are one of the world's largest pension investors with 600 billion euros, as Henry had mentioned. Of that amount, about a quarter of it is invested or managed out of the US office. And so we manage on behalf of about 5 million pensioners in the Netherlands. So just a little quick background on kind of where we are in the journey of responsible investing. I've been with APG since 2008, and when I started, there was really no ESG at all and part of our process and our day-to-day activities. But kind of fast forward to post Great Financial Crisis, there were definitely initiatives being brought within the company. And one of the biggest initiatives that first developed was the idea of screening all of our investments through ESG criteria. And what we did was probably what a lot of people have done is use third-party data providers as a general framework for screening companies and having bespoke criteria that's overlaid over that, that's developed in-house to kind of focus on what we think are the most important indicators to screen companies given each individual sector. So that was kind of where we started out, but over time, our clients' ambitions grew and they wanted to see kind of more direct impact, maybe direct measurement in what we did from day to day. And so we developed this framework called Sustainable Development Investments, which it's an asset owner's platform that was developed by several other asset managers, including ourselves. And what we did was formulate criteria based on the UN SDG principles. So within each industry or sub-industry, there will be specific formulas or calculations that would determine whether that investment is aligned with an SDG. And so through that process, we were able to identify companies that can meet that and have a more, I guess, clear-cut way of determining which companies are considered sustainable. And then a little bit after that, then came the advent and more, I guess, drive to green bonds and label bonds in general. And also that's something that we embraced as well as a vehicle to show impact, better way to see measurement of that impact and push for improved disclosures by companies. So that's the doesn't seem like stalled. Oh. Still mouse here.
There on the mouse.
Oh, there it is. Okay, there you go. Thank you. Okay, this slide, I'm just going to touch upon kind of our internal culture, and a lot of this should be, intuitive. But for us, on the left-hand side, it's about awareness and adoption. As a leading investor in responsible investing, we feel that we have the ability, we have the reputation, we have the scale to kind of push new structures in innovation in different areas and different parts of the market. Partnership is really important for us. It's not just about investing in a company and that's it. We look to develop partnerships for the long term, where we can get a better understanding of what that company's corporate sustainable strategy is, seeing what their needs are, and for companies that maybe don't really meet our criteria in terms of what is considered a leader, we will try to push for that change. But it's definitely a partnership, and it goes in line with engagement too. So it's not just about engaging with companies to improve their operations, but it's really also about how can they take action in their firm, which could also have a benefit to society, either environmentally or socially, and influence. It all goes hand in hand together. I think, company of our size, we have that ability to influence companies to do what they can do better than what they're currently doing. And then it's about balance. So a lot of people ask, are we willing to sacrifice return for certain types of investments? And the answer is no, we're not a philanthropy. We do have required returns on behalf of our clients that we need to meet. We have liabilities. So what we do is balance everything that we do in terms of investments, not just the return, but also the risks involved, the costs that are involved, and also of course, the sustainability aspect of it. So balancing those four quadrants are critical to what we do in every single investment that we look at. In terms of innovations that we're seeing, a lot of the things that we're looking at right now do have the following characteristics on the right-hand side. So it's typically off bench. It can straddle both private, public kind of characteristics. It's definitely becoming more bespoke in nature, some of the deals that we're looking at. And generally, it's less liquid, and some of them tend to be buy and hold. Most of the things that we look at, we definitely want to demonstrate a clear intention that there is positive social or environmental impact. And it's not just about the company's operations, but it's really about what products and services can the company, what is the company producing or selling that does lead to an impact on society. And another last point I'll make is repeatability. When we enter into a transaction with a company, we do look to do follow-on transactions over time. And that could sometimes lead to more bespoke transactions that in terms of addressing what our clients are really looking for. So the first transaction could be a test transaction where, all right, we're seeing what this company can do in terms of setting the right disclosure, the right metrics to measure. And if things progress, then we can advance that relationship and look at something maybe more bespoke down the road that even hones in more so what our clients are actually looking for. Here, the next couple of slides, I'm just going to walk through several transactions that we've completed in the past several years. The first one is Ørsted. Ørsted is the largest Danish energy company with 90% of their business in renewables. This idea or this investment was brought to us through actually a relationship that we built over time. So it's an example where we participate in a number of their green bonds over the years. And so we got to know the company very well, the management, and we got comfort in this company is serious about their ESG ambitions. And so the company was interested in doing a blue bond. They were working with some partners on kind of new technologies that they feel that they can apply to the construction part of their business. And so they came to us asking for feedback. If we were to do a blue bond, what would you be looking for? What are the kind of criteria that you would want to see? And so after long discussions with the company, we were able to help structure a deal where we want to push for increased exposure to biodiversity. And so there's several project examples on the left-hand side. And probably the biggest and most interesting one was this technology of air bubbles. And what that is, when you construct these windmills in the ocean, what they do is they basically lay down cables on the ground. And so there's two concentric circles, and each of these cables, there's holes, or perforated holes in these cables, and it releases air bubbles. And so what that does is it kind of creates an insulated construction environment, which kind of shields marine biolife away from the construction activity, and thereby reduce potential damage to the marine biolife in that area. They also are committing to enhancing bioreefs, oyster and seabird habitation. And then separate from the biodiversity, they're also investing in alternatives to diesel fuel, specifically e-methanol. So this was a relatively small transaction. It was 100 million euros, and there was only 3 investors. But we felt that there's just not enough investment in marine biodiversity. And so when this opportunity was brought to us, we definitely saw this as a great opportunity to kind of showcase to the world what is possible, and that there is much more needed investment in this area. Northvolt, the next example, this is more of a greenfield project finance example where Northvolt, it was basically a startup, and they were basically tasked to create like the first lithium battery manufacturer in Europe. And so this opportunity was brought to us by actually, I think, one of our counterparties on the investment banking side, knowing our background, and kind of just brought this idea and try to see what our interest was. It is, when it was brought to us, it was a very high risk investment. You're basically starting a company from scratch. The people who started this company definitely had very strong reputation from lithium battery manufacturing from other places. But again, it is a startup, and so we had to get comfortable with the structure, which took a while to, in terms of due diligence, risk management, talking with counterparties, talking about who would provide support in terms of the equity ownership, and also if there's any export credit agency support as well. And so for us, what got us comfortable with this transaction was the key off-taker was Volkswagen. They committed to a multi-billion-dollar contract to take batteries when production starts. They also happen to be one of the major shareholders in Northvolt as well. And so in our view, we were basically kind of taking Volkswagen risk in a way in this project. Some interesting facts about this company is that they aim to be the greenest lithium manufacturer, where 95% of the battery, when completed, is intended to be recyclable. And plus the raw materials that they use to make these batteries, their goal is to have up to 8% of the raw materials also come from recyclable parts. So, those two aspects alone just kind of tells you like the greenness of this project, and it definitely, drew us into this investment. And oh, by the way, the renewable energy aspect of it comes into play, where 100% of the energy used to power this production facility is coming from hydroelectric in Sweden. So despite the complexity, we got comfortable with the structure, the counterparties, and also the covenants that came along with it. The covenants are very tight. There's definitely very specific milestones that need to be met to release more capital as a production and manufacturing of the plant progresses. Next slide. Enel, you guys probably are familiar, but this was the landmark transaction as the first sustainable linked bond. We were one of the anchor investors with this bond. It's definitely, it was a unique structure, controversial and still controversial today. But at the time when we participated in this deal, we thought this as an interesting opportunity to promote a new structure where there is measurement specific KPIs over a certain time frame that is disclosed on an annual basis. And we thought that in terms of the structure that it did provide a comfort that the projects that were eligible were sustainable in our opinion. The targets the performance targets were aligned to SDG 7 with the primary goal of 55% renewables installed capacity. This next example is ILX. ILX is an emerging markets fund, which was brought to our attention because at that point in time when this deal was brought to us, we were actually looking for a vehicle that was off the benchmark that can enhance our emerging markets mandate and also lower our Sharpe ratio at the same time. So we're looking for something with lower correlation to what was currently invested. And so after speaking to some capital markets relationships, they brought this investment idea up to us. And what's unique with this investment is that it's, for us, we thought that this was a quick way to diversify our emerging markets portfolio across markets, regions, and also across development banks and across different sustainable areas of focus. So energy access, sustainable industry infrastructure, inclusive finance and biodiversity. So it's a very diversified portfolio. And also we also like the fact that we were basically co-investing along the lines with development banks and also the World Bank. So to us that this was a key feature where we felt comfortable with established players that have a strong track record. And it was a speed to market. So, you know, typically a lot of times you're investing in just one bank and you could just be isolated to one region, but this investment vehicle allowed us to invest across multiple jurisdictions in a relatively quick manner. And returns were relatively attractive too as well. On average, the spread is about 450 over floating rate. And also at the same time, so far to date, it has demonstrated what we expected to be, which is lower correlation versus the JP Morgan emerging markets corporate bond index and also the sovereign index. Last example is solar ABS. This is a recent transaction that we participate in. GoLeap is one of the leading providers of residential solar and home efficiency loans. For us, this was an interesting vehicle to promote residential solar panel adoption. The more that we can support vehicles like this, it ultimately comes down to lower costs for GoLeap in providing loans and lower financing for the residential borrower. So we like this concept, and this is just probably our first foray into this type of vehicle, but something that we look to do follow-on transactions in the future. The structure was also attractive for us. It has like typical aspects you see in the ABS structure. So we invested in the A tranche. A couple other structure features that there is EU retention rules with this transaction. There is subordination in this, and also there is a credit enhancement of up to, I believe, close to 30%. So the structure absorbed 30% losses before we would take a hit. So we found the structure to be very compelling. Relative value is also attractive relative to ABS prime, autos, and also subprime. Where this deal, I think when we priced, it was about like 250 basis points. And that compared to about 155 basis points for prime auto and 190 basis points for subprime. So definitely attractive in our view. The borrowers are also very attractive, very high FICO score is about 750. And so the customers are definitely incentivized to keep paying their bills, because if they don't, the range or the manager of these assets have the ability to shut off their solar, which definitely will hurt the consumer, because then they would have to pay more on their utility bills. Lastly, this is just kind of a quick slide on opportunities on the pipeline. We definitely see a lot in the US. I think we probably see considerable opportunities in the next 12 months. A lot of it is driven by the Inflation Reduction Act and also the CHIPS Act. So areas that we see the most opportunities definitely in the energy transition area. as well as social housing. With that, I think I'm going to wrap it up. Hopefully I didn't chew up too much time. And again, thank you for your time.
Thank you for that, Tom. Quite a range of transactions. Hopefully hopefully you'll stick around, and if there are any questions, we can pose those to Tom at the conclusion of the next leg of the event, which will be led off by Fiona Stewart. So Fiona, we'll let you take it away.
Thank you. Thank you very much. Good to follow APG, which is a strong partner of the World Bank in general. Very good to see you all. My name is Fiona Stewart. I'm part of the long-term finance team at the World Bank. I'm going to run you through some of the work that we've been doing on sustainable finance in general, but particularly sovereign EM is an area that we've been looking at a lot. This really came from work we were doing with another of the big elephants of the pension world, the GPIF in Japan, the world's biggest pension fund. And they came to us about 5 years ago now, and they wanted to introduce this, as Tom was saying, ESG right across their portfolio. And we know what this means for equities and beginning to understand for corporates, but we started to look, what does this ESG beast thing mean for the sovereign bond asset class, which is one of the biggest asset classes, obviously, for the GPIF, I'm sure for APG and others as well. And when we started digging, we realized that a lot of the data actually comes from the World Bank, sort of curated, or the data that we produce. In true World Bank big elephant fashion, it was all over the place. So we pulled it together into an ESG data portal, and then started doing quite a lot of work and digging into what was the sort of analysis that was being used for ESG and sovereigns, and found quite a lot of interesting analysis that we found from this. A lot of it was unexpected, in the sense that if you look at ESG and sovereigns, you would think if you put a sovereign overlay onto like an emerging bond portfolio, that you would be directing capital to the countries, the companies, the projects that need it most to meet the SDGs and the Paris Accord. In fact, you can unintentionally have the opposite effect, because so many of the ESG indicators that are used are very correlated to GDP. So unintentionally, you could end up pushing funds back towards the higher income countries, rather than the ones, our client countries, that really, really need it to meet the SDG and the financing gap. And then we also found that there was a very big gap in the E. So the S and the G relatively standard, but the E was a big hole, and different rating agencies like Peters and index providers and the data providers for ESG, the E was very poorly covered and very different. So that's an area that we started looking into a lot, particularly as the bank. We do a lot of work with countries on their natural capital accounting. So this idea of wealth accounting, and a country, you might look at fossil fuels still as an asset, whether it's stranded or not is a question in ESG assessments, but the amazing natural capital that the countries that we work in, Indonesia's, the Brazils, the Congos, have in their forestry, etc., was not well taken into account into this ESG analysis. So that's something that we were looking at a lot. We've been working with, and there's a difference, as Peter, you'll know, I think the ratings and rankings get confused. So there's some very specific issues for the rating agencies, the analysis they do over the short term, but some of these rankings for ESG, the FTSE Russell, for example, in their index provider, have started to bring some of this, correcting for the income bias, bringing natural capital into their accounting, and it can actually change the indexes quite significantly. So some, good work we've been doing digging into that. Going forward, a couple of the pieces that we've been working on the data, on the reporting, and on the instruments. I'll just run you through very quickly. So as I say, we've kind of relaunched a ESG sovereign data portal. You're very welcome to go and play around with it. It's all public. Incorporated an adjustment for this income bias, incorporated natural capital. So there's natural capital data in there, and also some benchmarking tools. It's quite difficult for when it's a country versus a company. How do you benchmark? Is it by the income? Is it by the topography, the geography? How do you actually which peer groups do you choose? So there's various tools in there for you to choose country peer groups to peer group against. So happy for you to follow up with that, but to play around with the database. And then another, obviously many of you all know, obviously the ISSB, the TNFD is launching today, the Task Force for Nature Disclosure. We've also been working a lot on what does this mean for corporates? What does this mean for DMOs? Because they're increasingly being asked the same questions as the corporates are being asked, these ESG questions, etc. And again, a lot of the very small countries, the small DMOs we work with, this is quite new for them to answer these sort of questions. They have to look across governments and to other ministries. So we asked the question of, do we need a TCFD for sovereigns or a TNFD for sovereigns? And so we've started working with IPSASB, the public sector equivalent of the SASB reporting group, to see if we can help have some bit more standardized reporting to really help, particularly the smaller DMOs we work with in emerging markets, get across things like the natural capital and these assets that they have, and the really good work they're doing in terms of their transition frameworks, the NDCs, ambition, etc., really helping them get that across. And it's quite new for them. So quite a lot of work we're doing on the sovereign reporting basis. And then you mentioned SLBs, Tom, but we're doing quite a lot of work on the SLBs. And as you say, it's been quite a controversial instrument. But we're also been looking at, can these sustainability linked bonds, how could they be appropriate for sovereigns? Are they appropriate for sovereigns for the public sector? And we've had a couple of issuances from Chile and from Uruguay. And we do think that they are potentially very interesting, particularly again for the smaller DMOs that don't necessarily have all the ring-fenced projects, big enough set of ring-fenced projects for a green bond. It's use of proceeds, but they really want to incentivize outcomes. You mentioned outcomes a lot. How do we really incentivize ambition and outcomes in our client countries? So we've been looking at these on a sovereign, on a public sector basis. We're working with the Development Bank in Rwanda at the moment, the BRD, to see they would like to do an SLB. We've used some of our lending. So we lend to governments, obviously, as we are a bank, but we lend to governments. Some of that lending we do to the Ministry of Finance has been on lent to the Development Bank, using that as collateral for an SLB, which really has ambitions in terms of their own ESG processes, gender-led finance, and affordable housing are the sort of areas and KPIs they want to go above and beyond the trend they're on, really sort of push for ambitious targets in these areas with the Development Bank. And we think this could be an interesting instrument for not just corporates, but for public sector issuers. The question is, how do you make sure that they are ambitious targets are set and feasible targets are set? And this has been one of the criticisms with the corporate SLBs. So we've been trying to build a framework to think about how you look at ambition and feasibility for a sovereign issuer. So this, for example, is coming out of, again, back to the database, the SLB portal that we've built. Senegal have just come out with their framework for sustainable bonds and issuance, which I hugely commend the Senegalese. It's a very, very, very comprehensive, worked with S&P actually as their SPO, very comprehensive document. So we've taken some of the KPIs they've been looking at to say, well, how do we know this is ambitious for Senegal? How do we know if it's feasible for Senegal? So for example, one of the things they want to do is primary education, primary school completion rates. So we've looked at, what's the trend in the country? What's the trend in their peers? And yeah, actually the target they've set through the KPI they want to be using in their framework is going above and beyond the trend, the business as usual. Great, is it feasible? Well, we look back at countries that have started at the same sort of level, 65% at the moment for primary school completion rate in Senegal. Over a 5-year period, have they been able to get to the 80+% that Senegal is targeting? And the answer is, yeah, we have seen that happen in other countries. So we think it is feasible. It's an ambitious target, but a feasible one. So we're building these sort of benchmarking into the indicators that we have in the ESG data portal, again, to help S&Ps and the SPOs and the third-party providers to think about how we might really think about ambition and feasibility in these targets. So we hope build some more robustness into the SLB market going forward. And finally, just to touch on, you can't talk about sustainability and innovation without rhinos. Everyone loves the rhino bonds, the World Bank rhino bonds. So this is it's a World Bank bond, same as usual, World Bank issuance. But what we do is we've taken, some investors have given up the coupon from the bond, and that's been directed to rhino conservation in South Africa. And then if there's targets for species increase and protection of the rhinos within this particular projects in South Africa, if they're met, the third party, the Global Environment Fund, actually then pays back the coupon to the investors. So it's a way of taking World Bank risk, but it does have specific outcome-based targets and is rewarding, outcomes for a particular biodiversity, et cetera, targets. So we've been working a similar one with Vietnam around emission reduction, but it's just another sort of innovative kind of way we're trying to think about to really encourage sort of, just as you're saying, Tom, the outcomes is really what we're focused on and the reporting around that. So just some ideas and happy to follow up. Thank you.
Yes, I'm next. See if I can figure this out. Oh, good. Yeah. Okay. Well, thank you for inviting me. It's a pleasure to be here. I'm going to talk about carbon-linked bonds, which are very similar actually to these, they have KPIs or sovereign, but they're a little bit different in that they're more like TIPS, if you're familiar with the Treasury inflation protected securities in the US. But first, let me kind of set the stage. And what I would say is, I'm a risk manager, and I often start talks like this by saying, time is a scarce resource when you're managing risk. And if you have enough time, we can solve almost any problem. But it's when you run out of time that a risk can become a catastrophe. And with respect to climate change, I think everyone here is probably aware that we're not making progress. The UN just issued its stock take report, said we're not on track. And there is some good news in the US. The government, passed the Inflation Reduction Act that at first was expected to provide something like $400 billion in subsidies to low carbon energy sources. And more good news, it's been really quite successful. Today, the estimates are that over 10 years, it may provide as much as $1 trillion in subsidies. Now, I should emphasize the difference between billions and trillions. I just slipped there myself. When the New York Times a couple of weeks ago wrote a story about the IMF having updated its estimates of the annual subsidy to fossil fuels, they said it was $7 billion. Now, I looked at that, I thought, well, that's kind of strange, because the last time I saw the estimate, it was about 5 trillion. And sure enough, it was $7 trillion. I just want you to think about that for a minute. $7 trillion per year of subsidy to fossil fuels. Of course, we're not making progress. You know what drives investments. You remember something called the Black-Litterman model? It was all about how sensitive portfolio optimizations are to expected returns measured in basis points. Well, friends, we have expected returns that are driven by $7 trillion per year of subsidies. In the US alone, the IMF estimates there are $757 billion per year of subsidies to fossil fuels. This is, of course, insane. It is, of course, a hurricane force headwind that's preventing us from making any progress. Okay, so if we're serious, if governments are serious in the world today, they are going to address the $7 trillion of annual subsidies to fossil fuels. Now, that's what the carbon-linked bond is designed to highlight and to address. So let's see how it works if we can. Okay, what the carbon-linked bond attempts to measure what are the global incentives to reduce emissions, both on the positive side and on the negative side, by different countries and over time, looking at a variety of policies. So we start with each country. the country-specific policy. This is not just carbon taxes or cap and trade systems. This is all policies that influence the consumption of fossil fuels. We also look obviously at the emissions and energy use by sector, and we end up with country-level time series of carbon pricing. We are following that over time. Now let's see what that looks like. Well, very quickly. So we have 25 countries. We have about 85% of global emissions. We cover 7 major policies, and policies are weighted by the amount of emissions to which they apply. So we get an average price on emissions in each country, and we follow it back over time. We go back to 2008. 2021 is the latest year for which we have data. This is kind of the main picture here. It's a very sad picture. There is no global, first of all, what are we looking at? The orange bars are the prices in different countries. The blue bars are the amount of emissions in those countries for 2021. So you can see that there's no harmonization. We have some countries, particularly in Europe, Spain, the UK, France, Netherlands, Germany are at the top of this slide. They all have incentives, including their emissions trading system, including fossil fuel taxes, including feed-in tariffs that amount to well over $100 per ton in those European countries. That's a good start, okay? The United States is in the middle with the global average. The global average is about $18.50 per ton. The US is about $18 per ton. In the US, 90% of that $18 a ton incentive is a gasoline tax. It was not designed to reduce emissions, but when you have an opportunity to buy an electric car versus an internal combustion car, a gasoline tax incentivizes you to buy the electric car and reduce emissions. That's the main thing in the US, 90% of it. You can see in China, it's below the US. You can basically see that as a world, we're not on track. And then there are many countries, especially in the Middle East, Russia, Venezuela, the United Arab Emirates, that are strongly subsidizing pollution. There are no policies to reduce emissions, and they have gasoline that is heavily subsidized, something like $3.40 a gallon in the UAE. Again, you cannot expect to make progress if you have incentives that are going the wrong way. We don't really have a lot of time. We need to get to strong incentives, and we need to get there immediately. Where should this be? Resources for the Future estimates that the social cost of carbon is around $200 a ton. So it's an order of magnitude higher than the global average. Okay. And I'm a risk manager. If you asked me, Bob, where should you set the price for carbon? I would not say the social cost of carbon, $200 a ton, because there's tremendous uncertainty about what that number really is. Do you want to have a 50% chance of saving the world? Or do you want to have a 99.9 chance? You want to be above the social cost of carbon. You want to be conservative here. You want to, anyway, we've got to change this, and we're not going to make progress until we change incentives. So that's the bottom line. Now, how do we turn this into a bond? Well, basically, I'm going to skip ahead here in the interest of time. These kind of show where, and let's just pause before I go about the bond. On this slide, we show where the global average, and also you can see where the US number is coming from in terms of what are the policies. Okay, the fossil fuel subsidies, that is one policy that every country that we've looked at has. They all have fossil fuel subsidies, including the US. You have a carbon tax in some countries, not the US. Emissions trading systems, fossil fuel taxes, feed-in tariffs, low carbon fuel standards, and renewable portfolio standards. The United States is pretty pathetic. We have to admit it here. Okay, well, how does a carbon-linked bond work? It's a lot like TIPS. TIPS, as you probably all know, the coupon and the principal are linked to the consumer price index. And so you're protected against inflation. Here, the idea is very similar, except that rather than linking the coupon and principal directly to the price of carbon, what we're going to link it to is the difference between the price of carbon at that date and a target price that a country will announce when it issues the bond. I should say a target path. And the way I like to think about it is, how long are we going to wait until we get rid of this subsidy that is killing us? What's the path to eliminating the subsidies to fossil fuels? Are we going to do it over 10 years? I think 10 years is probably a pretty good horizon. I would like to see governments issue 10-year bonds where by the time you get to the 10th year, the target is $200 a ton. And along the way, where are we relative to that target? And pay a coupon that if you're not at your target, goes up, okay? If you don't hit your target, you pay more. It gives governments the incentive to hit their targets. It also allows governments to signal their target carbon pricing intentions. It's like TIPS. The Fed says we have a 2% inflation target. I used to work at the Fed 40 some years ago, okay? Actually 50 some, but anyway, long time ago when Volcker was there and we were trying to kill inflation. And do you remember how we did it? We looked backwards. We looked at the latest money supply blip. It was insane. You know, by the end of the year, you'd go back and say, well, that 10 billion blip that we responded to by raising interest rates, now that we've got the updated data and the seasonal adjustment, it's not even there. You don't even see it. Okay, what we do today is we look forward. We look at market expectations of where inflation is. And if those market expectations go above our target, we say we've got to have a stronger policy. And the Fed has been very successful in following a forward-looking policy based on developing credibility. And that's what we need to do with respect to carbon. We need to announce targets. I don't expect the US to be first. If the US issued a bond like this, the market would say it's not going to hit its targets. All it would do is reveal the lack of credibility in US policy. And we need to move fast. Now, okay, if we have this and then you have an investor who wants to invest in a region, why would a sovereign issue this? Because it gives an investor a hedging instrument that they can use to hedge against the risk that the sovereign won't hit its target. You can go long this bond, and if the sovereign doesn't make it, you get a payout. So if I'm an entrepreneur or an investor who's investing in a low carbon solution, I know it's going to pull CO2 out of the atmosphere 10 years from now. I want to lock that in. This instrument allows that to happen. And then finally, just like with the TIPS, it illuminates investor expectations of future carbon pricing. You can compare the carbon linked bond with the nominal bond from an issuer, and you can say, here's what the market expects in terms of the carbon price at a point in the future. So hopefully we will find some sovereigns. I don't think the US will do it, but forward-looking countries that have strong policies, you know, and we've talked to several states could do this as well. So if you want to basically lead and try to drive the movement toward a globally harmonized, strong, liquid market in carbon emissions, I think this might be a good answer. Thank you. Oh, sorry. Correctly.
Good afternoon. I'm Joe Shara. I'm CEO of a small boutique financial advisory firm called Sabre Partners. And I'm happy to say in my audience today is Andy Kalate, who is also the vice chairman of our advisory board since the inception in 2000. He serves under Alan Blinder, who is the former vice chairman of the Federal Reserve and my professor of economics at Princeton. What I'm here to talk to you about is the power industry and utilities who are both the perpetrators of climate change and the victims of climate change, one might say, allegedly. And a specific financing mechanism that is keyed off of the called securitization, that is keyed off to the notion that we have a natural monopoly called your utility company, and the wires that go to your house, transmitting electricity and sales of electricity are government regulated. And you might have seen, doesn't have, this isn't in slide mode, is it? Oh. Oh, you should have told me. Because we had some great animations for you here that to bring things out. But I learned it being in the audience is that if you put too many bullets on the screen at once, everybody starts reading ahead or moving around. So I had it sort of controlled, but I've been subverted by the technology. So this would have come out in separate rows in which you might have seen different headlines that would have told you something. I'll try to work through this, but I'm sorry if it won't be as clear. So utility securitization in a nutshell. Sorry. You're replacing the utility's overall cost of capital, which is always referred to in a structure of debt and equity. And it's 50% debt and 50% equity. And that has a certain cost. We call that the weighted average cost of capital. So you're going to replace that with a AAA rated bond. You're going to play with some of the timing of payments. So there's going to be a levelized collection of the principal to repay these bonds as opposed to some accelerated. And it's repaid directly by ratepayers on from the parent utility's service territory. All the rights to this charge that's going to be put on a bill to pay the bondholders is sold through a special purpose subsidiary of the utility. And the regulators are required by law to adjust the charge, we call it true up, to whatever level to guarantee that the bonds are paid on time. So securitization, I call it as like a breakfast of ham and eggs, is where the chicken is involved, but the pig is committed. So the utility is involved, but the ratepayers are committed. Utility will facilitate this transaction, but the utility and its customers are not going to be responsible to be paid back 1 cent of what these bonds done. It will go directly to the ratepayers. Now, there are two types. I'm going to step down here, look at my own stuff. So you can hear me. So two types of government power. You might recognize one is the taxing authority, level, and regulatory authority. We've talked a lot about governments and sovereigns and everything. They're using their taxing authority. Income taxes, sales tax, property excise tax. There's also a power in regulation, and particularly in regulation of an operator.
We're on Zoom, so you can't do that.
Oh, I have to go back. Everyone wants to see me?
No, I think it's just the mic.
Okay. So the regulatory authority over a monopolist that sells electricity is very powerful. You cannot, the price of electricity is governed by regulation. And you can set the price, have to get government approval for the price. So there is in the regulatory authority also something similar to taxing authority in terms of setting tariffs and prices on sales. So what the government's regulatory authority over sales can create this AAA bond. You have special state legislation that authorizes costs such as damage from hurricanes or the closure of a coal-fired plant that needs to be done, or the purchasing of wind supplies or construction of wind. If the state legislature allows, it will authorize this type of charge to be put on everyone's bill, which is considered non-bypassable, and a liability of everybody in the jurisdiction, meaning that if you don't pay your charge, we simply take the losses and redistribute them to everybody else. And we do that every 6 months until the bonds are repaid. And It authorizes the government to contractually obligate itself to the bondholders that it will always ensure that that charge on sales is there and adjusted every 6 months to whatever level is necessary to pay the bonds. So the government's pledge, additionally, the state government pledges never to interfere with the bondholders' right to be repaid. Now, the federal government, no state pledges that on their own debt. But on these bonds, it pledges, it says it will not interfere with the rights to bondholders. If US government had that as a pledge, we wouldn't have a debt crisis because the bondholders would force the government to raise taxes or whatever it needed. But it doesn't have that anywhere, but in this type of bond, it does. And that is what is provided. So we're going to eliminate, we're going to substitute from the weighted average cost of capital of debt and equity to less expensive AAA. Elimination of that equity component provides a lot of savings, and the amortization and repayment period can do it as well. And this was a graph that would have come out easier. See, too busy right now. But in looking on the left, this is what traditional costs and investments for sustainable would become more on a declining balance with the types of revenues that would be required as you amortize a plant. Here, we're going to sort of levelize them. And if you see on the right-hand side over here, elimination of equity costs saves about 50%. You also don't pay income taxes for your electric bill. You're paying for the taxes that the utility has to pay to federal government, because you're providing an overall return of to the shareholders of the utility when regulated. So you're going to gross up everything for the bills for ultimately customers are to pay. So the rating agencies view these very favorably and give them a AAA rating because of that adjustment feature. Moody's thinks it's credit positive for the entire utility to use this type of financing for specific purposes. Fitch takes a little, thinks they're good, but doesn't want more than 20% of the bill. And S&P will take this debt off the balance sheet of the parent utility for credit purposes and sees that it's a positive in terms of recovering its costs. So what we've got here, a sustainable sort of recycling from taking from, let's say, the costs associated with retiring a coal plant and turning it into this charge, selling debt to repay the shareholders for their principal amount. They no longer get a return, and we turn it into a straight bond, and we can use the proceeds to reinvest in wind, coal, retirement transition. So if you go on the website and look for Google securitization and Sierra Club, you will get a big report that the Sierra Club did on securitization as a positive tool for sustainable investments. Many environmental groups, and we've worked with many in terms of help passing laws to allow this type of financing to occur. And let me give you a quick where it started. It really started before sustainable investments. Before it started in 1994 with using this bond for a small demand side management program. Then deregulation came, deregulation of the utility industry, separating the transmission and generation business. So transmission will always stay a monopolist. Generation became competitive in some states until it melted down. Then we had, and that passed with other states. These are mostly the states that deregulated their electricity markets before the meltdown in 2001. Then environmental costs started to come in about after Katrina, before Katrina, excuse me, for pollution control. And then Katrina and a bankruptcy of PG&E forced even more cost. Then it expanded. Coal and clean started to take a bigger portion of it. COVID, retirements, and coal costs. And so now there are about 18 states that can offer these types of bonds for specific types of purposes. And 16 laws have expired, but 3 other states we know are considering, I think it's Minnesota, Arizona, Connecticut, I think. And here is what has happened in terms of the issuance. Started out, as you see, small amounts, but as these amortized, amount outstanding came down and up here. What happened here? 2 things. Pacific Gas and Electric went bankrupt again. And in its bankruptcy, in part, it cut a deal with the regulators and the state that $7.5 billion of its fire liabilities would be financed through securitization with an offsetting credit from the shareholders, supposedly. Plus, the legislature spent another $5 billion for wildfire mitigation. And then there was this thing called Weatherization Uri event, which was this cold snap that happened in the Midwest and South, which gas prices shot up. And based on their pricing system, billions of dollars was cost overruns for fuel. And everyone came back with the solution. Hey, why don't we securitize it? Why don't we use these bonds? Try to get a lower cost. And that's what it was done. So stranded costs, which were originally for deregulating the electric utility industry, takes up the most amount, but environmental, storm, wildfire damages, pollution control, coal plant retirement are picking up as being used as part for this process. This was for 3 examples. 2 of them we've been involved with. Potomac Edison and Monongahela Power back in 2007 to 2009. They actually wanted to burn more coal from West Virginia in their coal plants. They didn't want to retire the coal plants in West Virginia, but federal laws required more controls on the equipment for pollution to burn the coal from West Virginia, which was dirtier than other places. They needed more pollution control equipment, finance it with securitization. Consumers Energy taking off a plant. Duke Energy in 2016 took off a nuclear plant that was broken and refinanced the costs. So the Climate Policy Institute sort of identified these sort of states where there are heavy uses of coal and where people are going to be pushing for more use of this type of financing mechanism to assist in transitioning coal plant retirements. But here's a big issue. It sounds good. Wall Street comes up with good ideas all the time. But is it fair? Is it efficient? We get a rating, get a AAA rating. And you say, well, what's happened to, this would have been a very beautiful chart coming out one at a time. I just want to let you know. Almost every one of my slides would have been better one of my time. I want to know, I spent a lot of time in these animations. But anyway, there were 15 corporations in 2000 that were rated AAA by Moody's and S&P. By 2023, there are only 2. And if you look at the amount of corporations and what's happened in the market, you're going to see that you have a dearth of AAA securities. We're down to like 1.2%. And I got to jump ahead here. We'll just go. So this is what's happening. They used to have these bonds right on top of other AAA corporates, but then a divergence sort of occurred beginning in 2021. And if you looked at this chart, this is a 15-year average life of a ratepayer-backed bond compared to a triple B index and a triple A index corporate, which has a weighted average life of about 15 years. And what's happened? We've gone from being on top of that triple A to being closer to triple Bs. So, and Wall Street celebrates this. They call them cheap triple A's. They're corporate, but in the ABS index, hey, when we add up all the pricings above where a triple A was really trading at the time, if you're in the fixed income area, it's about $3.2 billion in mispricings over the past 2 years. Is that a lot of money? I don't know. It's not trillion, but it goes to your electric bill and all those electric bills. And the average consumer needs to be represented. So we think they're a good bond for sustainability in helping lower costs, but you have to be sure that make them efficient. Markets are not naturally efficient. They are only efficient through the proper interaction between those who have to pay and those the ones you're trying to get money from, intermediaries, the investment bankers who want their piece, but somebody needs to fight for this. So that's it. Thank you.
Good afternoon. I'm the last person, so I am going to try and make this snappy. All right. So my name is Peter Gaudet. I work at S&P and I do not work in the ratings department. So don't ask me. I don't know. I am a financial and capital markets guy. I sit in the Commodity Insights division, which means that if you are a financial or capital markets institution, a investment bank, hedge fund, asset manager, private equity fund, and you are interested in anything to do with the energy transition, you will come through my group and we will help you figure out your problem. What that tends to mean is that I work alongside a lot of these firms as they do deals. So I'm a very deal-focused guy. At first, when I started doing energy transition work, as opposed to the 20 years I spent doing oil and gas and coal work, things were kind of slow. We were doing a lot of fundraising and we were not doing a lot of investment or distribution out of the funds we raised. That has changed very dramatically over the last 18 months. The energy transition, at least in the power sector, is underway already, and it has accelerated very sharply in the last year. This is something that is very important in part because as this happens, it will also kind of unfold a lot of other disruptions in the market that need to be focused on. This is not just a one in, one out. We're not going to notice the change. This will change not only the energy markets, but also the markets that then rely on energy inputs. For example, we are already seeing large manufacturing concerns relocate to areas where large amounts of renewable power are being installed because that power is so cheap. In many cases, it is below cost they are charging it because of the incentives in the IRA. You're watching the manufacturing supply chain in the United States relocate, in part because of this energy transition. So things are moving very quickly after a lengthy period in which we were putting a lot of money aside for this, but had not yet deployed it. And the Inflation Reduction Act in the United States is kind of the precipitating factor here. But we issued a paper on Friday alongside our ratings colleagues that point out that this is happening in all of the major economies. This is happening in Europe, in part as a response to the IRA. And in China, the additions of solar are larger than the entire rest of the world's additions of solar combined. An enormous amount is happening in this space, and it's important to keep that in mind because I think that there's a lot of focus on the gap, on the financing gap, and that's very important. We're not going to hit net zero just by building a lot of solar and batteries. On the other hand, what is happening today and what companies are finding profitable to do is installing this super cheap, albeit intermittent power. So $500 billion looks like the past. We will definitely, at this rate, surpass the $1 trillion mark on the IRA. There are complicated politics around that I'm not going to get into, but at this pace, we are more than going to pass $1 trillion. One of the things we need to remember is that this is not pure spending, this is investment. So we have needed to spend on the transmission system my entire career. So we're talking 25 years now since we invested in any meaningful way in the power system in the United States. In many cases, you look at this and you wonder how the US economy could even have grown given how little we invested in energy. That needed to happen. In some ways, the IRA allows us to do that, to make those investments with a cleaner set of inputs. Clean electrification is outpacing industrial decarbonization. What I mean by that, and this is why it won't take us to net zero, is that stuff like jet fuel, heavy transport, cement and steel manufacturing, a lot of things cannot be done by electrification, and the blend of technology and capital allocation and willingness are simply not there yet. We do see a path to some of that, so I don't know that this is time to give up yet, but right now, today, the money, the deal flow is in electrification. This has really been about living at the intersection of these two revolutions. The first on just how cheap clean energy has gotten, and the second is on private capital. Private equity firms and private debt firms have dominated deal flow in this space, and I did not expect that at all when I came into this job. I expected to work with oil companies and investment banks, and instead it has been private equity firms doing one deal after another. So often when we look at deal flow at S&P, we get caught up on the big investment bank transactions that support M&A. And most of that is still happening in the oil and gas space. So we're like, where's the clean tech deal flow? If you pay attention to the sort of sub $200 million flow, every single day you get multiple transactions. And over time, that amounts to a very significant amount of money. And it speaks to the different economics of the energy transition, that this is a manufacturing economics, it's real estate economics. In many cases, it's consumer economics. And those are all things that private equity firms do really well. They also have big tax appetites. And the IRA at its heart is a tax bill. It uses the tax code to leverage investment into these funds. So in many cases, what we have seen is that particularly when it comes to distributed infrastructure, some of the stuff you can roll out fast, they have done this with a pure equity capital structure. They have not even taken any debt. That part's about to change because we're nearing the end of that sort of low-hanging fruit around what you can do with equity. And we are going to need banks, big debt funds to step in. You saw SocGen and Brookfield raise a big energy transition debt fund last week. Will private credit be able to underwrite project finance? It's an open question, but they're really going to try. So the other thing I wanted to note is that the European and Asian banks have moved much faster on especially the fixed income piece. We can already see that the bigger projects, the utility scale, the industrial scale projects like we need for green hydrogen, those are happening in Asia in part because it is Asian banks who are willing to underwrite them at this bond level, at the debt level, and then match that with an offtake agreement. So this is just, when I first started pulling together something for a report called Is the IRA Working earlier this year, I had not expected to see renewable electricity as a target of private equity investment. To me, private equity firms invest maybe $20 billion a year total in clean power. They've done that for years, in part because that's kind of the cap on tax equity in the old system. The new system allows you to move around your tax credits that you earn. So if I am Blackstone, say, and I have a several $100 billion real estate portfolio that's coming up for billions of dollars in a US tax bill, I'm invested in a lot of high profit tech companies, I'm about to have a big tax bill, I can use the tax credits that I gain from investing in solar plants and apply them to the tax bill elsewhere in my portfolio. Or I can sell them to a company like Google, Apple, Microsoft that have very large tax bills. So this is an ongoing deal flow that was built into the structure of the IRA. So this is something that we're evolving. We're working on trying to get an understanding of how the kind of capital stack is shaping out for the transition. So everything from solar through CCUS, it kind of falls under my area. Increasingly, however, industrials also fall under my area because advanced manufacturing and all the new investment in battery manufacturing, EV capacity, and so on is very much more linked to what you see on the right of the industrial line as opposed to the left. It used to be the gas price sets the marginal price for everything else. That's no longer the case. The clean electron price is the new baseload price. And that is going to be the case in more and more of these markets going forward. So I think that what needs to happen, and it will be down to some degree to the people in this room, is that green needs to go further down in the capital stack. If we don't get cheap bank financing for some of these bigger utility scale projects, they're not going to happen in time. So the debt market has kind of reopened in the last few weeks. What I hear anecdotally from bankers is that a lot of project financings that have kind of been in limbo over the summer will start to move ahead. By the time I update this chart at the end of this year, my hope is that we will be able to change a lot of those yellows to greens because we will see more deal flow in those areas. Now, private capital has just dominated far and away. One of my favorite statistics is the private equity firms that we work with are about to outspend all 46 publicly traded utility and power producers in North America on renewable energy this year. That's a remarkable shift. The people who own your power production facilities are going to be very different than the people who owned them in the last generation. And how they manage those and where they look for margin in that structure is going to be very different from the utility market that we heard about earlier. So this is happening in the US. This is increasingly picking up in Europe. We are not seeing as much private equity involvement in most Asia markets, but India is an exception there. They recently shifted around the dollar-rupee convertibility piece and regulations, and that has allowed a lot of private equity money to move into the India market, and we are seeing deployment as a result of that. That one on the right is a way of expressing the same thing that the chart before said and the chart after will say. We need more debt in this market. If this capital structure does not grow up and evolve and get bigger, it's not going to support the actual deployment of all of this money that we've allocated for. So we heard earlier about we're at about $500 billion in IRA money. We're easily headed to $1 trillion. We're only at about $110 billion of that having actually been moved into investment so far. So there is a construction boom in the United States. It needs to double or triple in size to get anywhere close to where we need to be to meet the IRA goals. The thing that I expect to happen is that once you start building super low cost power, it puts out of the money a lot of the natural gas, coal-fired facilities that exist today. You are going to have this kind of ongoing incentive to invest in more low-cost power over time, barring regulations like what you had in Texas earlier this year, in which the state actually steps in and supports natural gas generation in the idea that it is more stable. I'm not arguing that it's more stable. We're going to see a lot of very strange business models over the next coming years, in which the same groups that argued against energy subsidies for clean power are themselves going to become dependent on subsidies as part of an energy security play. So wrapping up, this is again another way of expressing that we really need more debt in this market. We need more fixed income. I don't capture everything here, but my understanding is that there are over 100 different projects waiting around for project financing close. They have all of their paperwork in order. The bankers are sitting on it. And as these markets reopen into September, October, November, we're really hoping to see some of that flow through so that we can begin to see the market plan to adjust for these. I think the power market regulators need to be paying attention to this. Anyone who invests in or rates the debt of big public utility companies and independent power producers is going to need to be paying attention to this. As we produce a huge amount of low-cost power, a lot of that will be turned into hydrogen. So if you run a chemical company, if you run a gas utility, if you run an industrial concern, you're going to be incentivized to use hydrogen because it's going to be so cheap. By some estimates, the incentives in the IRA are so generous that if you stack them correctly, the hydrogen itself, you could vent it and still make money on the underlying construction of the project. they will find a way to use this hydrogen. If they are producing it that cheaply and it is a usable energy source that we understand, it will switch in for other types of fuel. So I always enjoy the Q&A the most, so we'll move on to that, but thank you.
Thank you, Peter. Thank you, everyone, for making it easy to allow us enough time for Q&A. So much appreciated. So we've got 20 or so minutes for Q&A up until 5:15. What I would ask, we'll pass the microphone around. What I would ask is that you identify yourself and your affiliation and then present your question. So I'll walk around. I'll walk around with the microphone.
Hey, everyone. Good to listen to all of you. It was all very interesting. Joseph Stern, I work at a company called Flow Carbon. A question for Thomas. What are the specific returns that you look for in the deals that you were profiling? And does that range? Yeah.
Sure. Yes, the vary. Portfolio that we're looking at that each of our asset classes have a role. So right now, most of our investments are that kind of aligns the impact rate investment. That's totally part of the thing that we don't have separate portfolio. So we do have to be mindful that it does need to have a return. You have to look at that. So with the balance, structure, the risk allocation, so far, the lessons that we have to
Yes, based on construction.
Hi, Eric Tucker, Silverleaf Partners. Interesting on subsidies, and one is through the Inflation Reduction Act. I'm wondering, it seems like the private sector is responding. Looking back, what are the good and bad elements? How would you, if you were writing the act today, how would you change it, and what would you applaud? And then on the global number for subsidies for the fossil fuel industry, that's a tremendous number. I know, right, people riot sometimes when they raise the price of gas. So I'd be interested to know anything more on the breakdown of those subsidies and what's going on in this country where we're still subsidizing fossil fuels that might be changed. Thank you.
So on the IRA, the thing that is missing from the IRA are demand mandates. It is a supply side bill. And when it passed the way it did, the first thing our power analyst said was that they've just broken the US power market, because you had that much free intermittent power onto the system, and you're bankrupting essentially any company that was built on the basis of having to maintain an ongoing fossil fuel infrastructure. So how we manage that supply side boom without a matching demand side boom is turning out to be very difficult. If you look at other countries that have done what they call strategic interventions around mandates, and they can be relatively small in percentage terms, it does enable a more kind of considered negotiation around offtakes and timing and project financing. And that's been a little bit of a smoother looking process, looking ahead. But, you know, in the United States, we like to move fast and break things, and that the bill reflects that.
Yeah, on the IMF estimate of the subsidies, it's a really good, there's some good economists there, and I encourage everyone to just read the report, which goes through it in detail. But the bottom line is there's both what are called explicit and implicit subsidies. The explicit subsidies jumped up over the last 2 years because of the war in Ukraine, but those are actual monies that are spent by governments, taxpayer money, to lower the cost of fossil fuels. It's absolutely insane. And then the implicit subsidies are the fact that we're not charging for the externalities that are part of burning fossil fuels. And they're huge. Everyone knows it. Economists measure it. They're different in different countries, but they did a very good job in looking at all these costs. And the only thing that I would say that I question is they use a social cost of carbon of $60 a ton. And the reality is way north. And as I said, I wouldn't suggest we price at the social cost of carbon. We should be well above that. So if anything, $7 trillion per year, $757 billion per year in the United States is the headwind we face. There's no way we're going to get to net zero in time. No way until we face this reality.
Just to add very quickly, IMF colleagues with their bank colleagues have a very good tool called CPAC Capital Carbon Pricing Tool, which exactly looks at this question. How do you start to unwind this without the social consequences? When and how do you then move to more targeted subsidies? Because these untargeted ones, obviously it can very much be the higher income in the emerging markets who benefit from these subsidies, not the lowest income groups.
Absolutely. So there are very difficult issues here associated with it, but I'm an economist. Ask yourself the question, the price, if the incentive today is down here and the appropriate incentive is up here, what's the appropriate time path to get there? What's the appropriate delay? The answer is none. We should have appropriate incentives at every point in time. Okay, now, to your point, Fiona, there are transactions costs. We should think of this as transactions costs. How long does it take us to get not to the end of fossil fuels? How long does it take us to get to the appropriate incentives? And I would say 10 years is plenty of time. I would have a hard time defending that. Why not 5 years? Okay, and let's address the issues of the transactions costs. But, you know, the damages are very real. You're seeing them every day. Let's not start talking about sea level rise and, you know, all of the other things that are going to happen. $1 trillion damages coming at us because we're not facing this reality. It's just insane.
Just one other thing in terms of in addition to transactions costs, environmentalists and others are recognizing there's transition costs in terms of particularly in plant and equipment, coal-fired plants. Communities are built around many of those plants, particularly in New Mexico, which was a plant that was scheduled to be closed, looks like it's going to stay open more because of the community pressure. One of the things that has been suggested is that they add to this type of ratepayer bond that we talked about, not just the costs associated with the retirement of the plant, but some additional amounts for transition to the community. Again, environmentalists find that very attractive, sort of like free money, but what happens is that many of the ratepayers in the community aren't necessarily wanting to pay for additional amounts on their bill just to help a plant to close somewhere else.
No one wants to pay higher costs. But the reality is, if we put a tax on carbon, there would be $4.4 trillion of additional revenue to governments. That's the IMF estimate, $4.4 trillion per year that could be spent on this transition. So I don't want to hear about the costs of the transition. The reality is $7 trillion of subsidies, taxpayer money, going to fossil fuel companies. Who wants that?
Probably those fossil fuel companies.
And that's why it's still there, by the way.
Shareholders and the taxpayer.
Lucas, Fordham Master's of Finance student. The question is for Peter, but overall to the table, what's stopping banks for getting into the transition? I'm as surprised as you. I think the benefits are there, the PDC is indexed to inflation, receivables are good. What's the hurdle?
You and me both asking that question. So I was in a French bank earlier this year that said that they were doing more project finance than they could handle. They were flying people in from Paris to do these deals. At the same time, they have not actually closed a number of them, and that's partially due to the structure here. When you are building 150 megawatt solar plants rather than one 5,000 megawatt gas plant, the financing requirements are very different. It's much more attractive for a bank to do a single massive underwriting than necessarily service a private equity platform that's going to try to get them at the lowest possible price. So that's part of what's going on. The SVB collapse at the end of the first quarter did create a mini credit crunch, and banks really did stop lending in the United States for a little while. And that part is the part that's loosening up now. We'll see by the end of the year whether the thaw in credit conditions has enabled these projects to move ahead, because a lot of them, as I understand it, have gotten all the way to the final finishing line and just need that extra, willingness on the part of bond buyers, essentially, to take it off their hands.
Alex Moreira with Florida International University and Nazca Impact. My question is for Fiona. Very interesting to see SLBs migrating to sovereigns. And as I understand SLBs, you don't have a specific use of proceeds requirements. It's just a set of KPIs that you have to meet, right? And so what are the different uses that you see between results-based finance and SLBs? How or is one a subset of the other?
Because I think you can see them as complementary. So you could have a use of proceeds specifically for a certain set of projects or whatever to fund. And then you could also have an overall SLB for a country that has a target along the lines of what Bob's saying. So I think that actually could be very complementary. And you've almost, countries like Benin, for example, that had a green bond, a use of proceeds green bond, but then they had very, very strong reporting on outcomes. So they're kind of 3/4 of the way to an SLB. So I actually think they're very complementary. And some countries, the large enough countries, have enough projects for a ring fence. The small countries don't. They may not have enough to have a big enough bond, and they don't want to fragment their bond market because it's a very small bond market for a lot of these countries. So I think they're more suited to some countries than others. But I think exactly this, the blend of them, could be very useful.
Scott Bryson from Orbital Farm. A question for the panel. So, and related to the previous one, green bond issuance, you're seeing 3 to 5 times more demand than the actual issues that are going on there. Can you guys comment on earlier stage projects that are in the pipeline and liquidity to finance those companies? Because it seems to me that we need a significant amount more early pipeline project development that's incredibly difficult to access any capital at that stage with projects. And do you see things that are increasing liquidity in that sector of the industrial project finance world?
Yeah, I mean, so there's always been this valley of death question, right? That you need to be able to get to scale in order to borrow money, and then you can't borrow money until you get to scale. So one of the things that's been really striking has been to see the evolution in technology around solar and batteries and onshore wind to the point where it is now possible to cross that valley of death without any problem. The application mixed with the improved efficiency, mixed with the lower cost, makes it pencil out from the beginning. It's a commercial project. Still the case with hydrogen, CCUS projects, these kinds of things, where that you can solve that problem in part is with the transfer market from the IRA, in which you can treat those tax credits as a cash proxy and get lending against it. And then these long offtake agreements. So the longer the offtake agreement, the lower risk for everyone involved. where we see long offtake agreements, you see project financing for earlier stage technology get done.
Hi, everyone. Weferi God from Amalthea. Thank you to the panelists and the keynote. Question for everyone, actually. Tom, most of the examples that you provided are based in Europe, and I think, Peter, you also alluded to APAC and Europe surpassing the US. Do you foresee the US catching up? And what would be the driver beyond the IRA? Is it enough? What would be the other drivers that would help?
Start off, I think it's a function of this Europe still being ahead. So, I think eventually the US will catch up. Just what we're seeing internally, we do see a number of deals that are in the works. It's just that I can't talk about because it's, we haven't completed it, but I expect by, 12 months, from now, we have a number of examples in the US. And so what we're hoping for is that examples that we participate in or in our overseas offices, we can point to that to our capital market counterparties. Hey, like Ørsted, Norfolk, we are looking for examples like this in the US. And I think it's just part of the journey that in the US, the corporates are maybe a little bit earlier and they're just not there right now. But we definitely have active feelers out there to find the right company with the right structure. So I think it's just a matter of time. And then with respect to the IRA, yeah, that's definitely a big catalyst. But I think from what I understand, and correct me if I'm wrong, I think that the tax requirements that still need to be hashed out and to be finalized. But I think once that is clear, I think we should see an acceleration of investments. But I mean, there's definitely a need for capital on the debt side, as the panelists have alluded to, and definitely we plan to be a partner with the right projects and the right issuers.
I mean, so when it comes to APAC, the thing you have to remember is that you have to go ex-China, because what China can do in terms of rolling out industrial policy is so remarkable. And that's just purely from a scale perspective, what they can do on solar. I think we've really underestimated what's going to happen when all of these cheap Chinese electric vehicles begin. I mean, you've already seen Europe begin to object to this. I was in Latin America not that long ago, and you can already begin to see a lot of BYD and other vehicles on the road there. If you are a family in Vietnam buying your first car, there's a very high likelihood that that's going to be a super cheap electric vehicle, and that it's going to be filled with power that has been, related to an offshore wind farm that has been financed by a Chinese state bank. I mean, it's an ongoing ecosystem. And so I do think that for all that the IRA has been astonishingly successful. I mean, the IRA economy is rolling forward a little bit more strategic planning around which markets we actually want and which markets we're not as keen on defending in the United States will be an argument that we'll have to have, and we'll have it in that messy, democracy election-led way. So.
I think we have, I think we have time for one more question before at least one of our panelists has to leave. Sean, I saw you come in very late, and I don't mean to put you on the spot. Thank you for joining us. Do you have a burning question that you'd like to pose to the panel before we call this to an end?
Yeah, thanks, Henry. I'm Sean Kidney. I'm the CEO of the Climate Bonds Initiative, a global NGO for green bonds, and work with Fiona, amongst others, globally. Look, a side question, Bob. We've been talking about carbon pricing for 30 years now. We still don't have it. When will an elegant theory in search for a practical application be given up to the real ways of doing things, which is the IRA, industrial policy, and so on, which is how we move things quickly. So I'll just leave that thought hanging with you. As much as I always agree with you on these questions, I just want to get stuff moving, and I see stuff moving because Chinese industrial policy, well, renewable energy is up a third this year on last year in China. In India, we have industrial policy now, mainly to get to reduce the current account deficit, therefore reduce gas. In Europe now, we have Repower EU on steroids going forward for a variety of policy measures. So there's a carbon price in there, and CBAM is happening, industry application, etc. But the real question is, why are we still so behind, given how much we have to do, I suppose, is the real question.
Yeah,
How
the
can we
real
get
question is,
IRA
why are we
2, 3, 4?
behind? And it's politics. That's what it is. And it's someone said it before. Who benefits from that $7 trillion of subsidies? We know why it's there. The politicians are paid for. You know that. And by the way, Europe, let's talk about it. They are way ahead of us. They are much cleaner. They have a carbon price. It's not that we can't get a carbon price. It's when do we get it? And let's focus on it. That's what we need. What are the steps to get us there? We will get there. It's just 30 years too late. You're absolutely right about that. And we will suffer. Our grandchildren will suffer 6 to 12 feet who are alive today of sea level rise because of that 30-year delay. The whole problem has been the last 30 years. So let's get on it.
The time is now 5:15. I'd like to have you join me in thanking our panel for a great discussion and Tom for their keynote address. Thank you very much. While one or more of our panelists may have to leave now, hopefully the rest will stay to interact with you, have some refreshments, light refreshments outside. And if you have any additional questions, you'll have an opportunity to ask them at that time. Thank you very much for attending, and we hope to see you soon at another FIASI meeting.